Alright, let's look at the next set of ratios which are primarily from a profitability standpoint. So and now we will do the analysis from multiple dimensions. One is a profitability dimension. Again, company, industry, competitors. Company across the history, competitors and the industry. These three will constitute the complete analysis. Again, the way we compute the data is more or less the same. Now when I look at some kind of profitability ratios, the most common things that come up are gross profit margin. So the gross is only taking out the cost of goods sold, which would be the first three items of our expenses: cost of consumed as well as outsourced as well as change. So that would be your gross profit. Then when we talk about operations profit, it will even remove out your selling and general administrative expenses as well as your employee costs, which is your EBITDA. That is what constitute to your operations profit. Then we can also talk about the net profit. And EBIT is also one good stuff. So probably let me put one more in the middle, called as operating profit. So otherwise called as operating profit margin, where I am looking at EBITDA. I'll take EBITDA divided by sales. Whereas here gross profit margin is sales minus, instead of talking of raw materials, I'll call it as cost of goods sold, which is the material, divided by the sales. Here whatever we are talking of sales is the net sales. And so I can talk about, so when I say EBIT, from that EBITDA I simply subtract depreciation and I'll get the EBIT, which is generally taken for all kinds of valuation purposes, because EBIT is the money, the money left in the EBIT will go to three players. One, it will go to the interest, whatever is EBIT, something goes as interest out of it, which goes to the debt investors or lenders of the company. One goes to the government in the form of tax, and the remaining goes to the equity investors. So it's an amount that goes to the investors as well as government. All expenses are taken care of. So EBIT is another way to do the valuation of the company in a better manner. So that's where EBIT margin is also something good to look at. PAT margin, which is the final profit after tax divided by the sales. So all these four ratios, we will divide them by the sales itself. These four different types of profit, which are arrived by in terms of percentage by dividing them by sales, right? So these we will see, how is the company worsening or progressing in all these factors, right? So okay, let me try to compute this part. Here I will say sales. So the sales is this one, the net revenues, minus the cost of sales, which is the sum of these three items. These three I take it as material, right? Because those three are related to the raw materials itself. So this minus the cost of sales, again divided by the sales. So this is what is my gross profit. Okay, in this case I can say that my gross profit is almost around 46%. So you see the percentage wise every year, the gross profit is almost around 46, 46, 49, 48, 46. So almost around 46, 47% is the latest gross profit of the company, which means the materials are costing around 53%. Again I will see, is the cost of materials higher compared to the industry or competitors or lesser? That will give me a big picture. Okay, this in case these are higher, then I can very well say this company is losing out on the profit because its cost of raw materials and all is much higher. So it has to find out some other way in terms of reducing that cost, because the other companies have a reduced value, lesser value. So that way we can compare. See, at the end, comparison is with what? You cannot compare HUL data with Infosys data. Right? The businesses are completely different. But at least HUL with Dabur is still logical. Right? So that's where when we try to make an industry average or competitor, we try to look at in which numbers this company is more. So that's where as a first analysis we will even look at it with respect to its past itself. Or probably my first question will come in 2011, 10 and 11, its gross profit is almost 2% higher than what is it is now. What had reduced? Which means the raw material cost has gone up by almost 2% in the last 2 years. Is it because of inflation? Is it because of what? That's one question which we generally have. So if the entire industry it has gone up by 2%, then probably I can say in general in the economy itself there is some problem. Could be an inflation or something which has resulted in the materials cost going up for everyone. For this company, the gross profit has reduced, means the only factor is the cost of materials has actually gone up, because that's the only thing contributing to the gross profit. The material cost has gone up, right? So is it the same for everyone, or is it only for this company? That will come when I do a competitor and industry analysis. Then similarly, operating profit, where I take EBITDA by sales, which means operating profit even takes care of even the employee costs, selling and administrative other expenses also. All operating revenues minus operating expenses. So which will come out as EBITDA is already computed here. EBITDA divided by sales. So it says almost 14.88%. Yeah, now let's see a better number. 14.88% is your EBITDA. Look at these two. Here this is almost 2% lesser, but here it has almost 2% more, or 1.5% more. Right? Which means if you look at the difference between the two, the difference between the two is employee costs plus other costs. Correct? The difference between the two is employee costs and other costs. You see that cost is almost 33 or 35 point some percentage. Whereas in this case, it's only 33% or 32%. This is 32, whereas this is 35. So at least the company has drastically reduced its employee cost, either employee costs or other expenses, which is selling, administrative, any such kind of expenses. So that's one good sign, because though the gross profit wise it has fallen, it tried managing its operating profit on a high note by cutting down some. See, raw materials cost may not be in the hands of the company, right? But other expenses, probably the employee or some of the stuff, may still be within the hands of the company. Advertising, sales promotion, the company can still try to cut down on them so as to maintain the overall profit on a higher note, which is what they have done, which is a good activity, right? And the other thing I can look at is EBIT, which means after removing the depreciation from EBITDA, I will look at what is the proportion that is going both to the equity investor as well as the debt investor and the government. What is the final profit after all the expenses have been taken care of? This is what I am looking as EBITDA minus depreciation divided by sales. Almost 12.72%. To even there also the company is around 13.89%. Even after the depreciation is taken care of, the company's profitability is around 13.9%. Right? And which means that for every 1 rupee of sale the company has done, these three people are taking 13.9 paisa. Right? Whether it is the debt investors in form of interest, government in form of taxes, or the equity investors in the form of dividend, or in the form of the remaining profit. I don't say dividend, remaining profit. So 13.9% is going to the different types of investors in the company. The higher the number is, the higher will be your share price. Because once the company is making higher and higher profit, obviously the expectation of the company will be much, much higher. People think that the company is performing beyond the expectations and they will invest more and more in the company. Right? So these profitability ratios play a key role when we talk about investments in the company. Very recently, probably when you go back and look at the recent annual report of Infosys, they have shown the profitability ratio has gone much lesser compared to its previous years. The immediate impact, 10% down of stock price. Did not show a loss. It showed a profit itself. But it was much lesser compared to the previous years and compared to the competitors in the percentage like this. The moment the percentage here falls, you will see the stock price also falls. That is where our Satyam and all, they try to maintain the profitability at a higher level so as not to make the stock price fall. They did all kinds of manipulations in the financial statements so that this number will still lie at the top. Because the moment you see a dip, you see the stock prices also will fall like that. Because no one is with an intention to buy that share. The demand will fall for that share. Obviously, the stock price has to fall. Because as we have seen, the stock price growth is primarily because of the hype. The book value is only 18 rupees, whereas we are seeing the market value as 502. There is a huge growth. There is a huge premium associated. So, as long as the results are good, that huge premium is maintained. The moment you see that the values are down, that huge premium will come down. Right? Okay, then we are also looking at the final profit which is going to the equity investors, which is PAT. In this case, probably may not be big difference. The reason being this company does not have heavy interests and all because they are almost a zero debt. So the interest does not exist. But whereas if the interest exists, the EBIT and PAT will be a slightly different stuff. But of course, here the taxes do exist. So only to that extent of taxes there would be a difference, not the influence of interest. So, but at least what this final ratio talks of is, okay, PAT divided by sales. So finally the equity investor is getting 12 rupees 16 paisa for every 100 rupees of sales of the company. So the remaining 1 rupee 63 or 73 paisa here is taken either by the debt investors in the form of interest or the government in the form of tax. Right? So this number is what will have an influence on the stock price. Right? The profit the company is generating, profit percentage, the net profit margin, has a huge impact on the stock price, because net profit is the profit which actually goes to the equity investor. That's fully the equity investor's money. Right? Whatever the final profit the company has generated, it actually belongs to the equity investors. So that's where net profit margin has a very serious impact on the stock price. So for every company, we can simply look at the net profit margin. If at all any company has shown a very high net profit margin in a particular quarter, there is a huge expectation about the performance of the company. You'll see the number will be very high. So everyone wants to buy that stock. Right? So here also I will compare with respect to its competitors. If something is very high with respect to competitors or very low, if it is very low with respect to competitors, sell off. Right? One simpler way. I mean, it's not that see, there may be situation where this quarter they may have performed lower, but they have a huge potential. Even those kind of things will go into the next advanced level, where I focus on the valuation aspects. But only from a financial statements, if I have to make a few decisions, the higher these numbers are, the better is the profitability of the company, and the better it is to invest in these kind of shares. Okay, then the most important areas are the return on equity. The crucial part for any investor. Right? Probably one key area, if you ask couple of key areas to look at while taking any investment decision, one thing I talk of is return on equity, which talks about for every 1 rupee that has been invested into the company, how much profit. It's not about 1 rupee of sales. 1 rupee that came into the company, what is the profit? Right? The higher is the ROE, the better is the performance of the company. Straightforward interpretation. Right? Now, that is nothing but the PAT divided by the book value of the equity, which is the total shareholders' funds. Because that is the total capital that has been invested into the company by the equity investor. So I will simply bring it as PAT divided by book value of the equity. Book value of the equity is this one. This tells %66%. This is the reason why the investor is still investing in the shares. For every 1 rupee that has been invested into the company, 66 paisa is the profit the company is generating. That is one of the prime reasons people are ready to purchase it even at such a high premium. Because even if I purchase it at a very high premium, probably my return would be still 12%, 15%, whatever it is. I will get that level of percentage. Because with respect to invested capital, there is a huge return. The profitability of the company is phenomenal. As long as, another decision to simply rule here is, as long as the ROE is greater than the investor's expected return. As an investor, what is the return you expect? Let's say 15%. Right? You want every year 15% kind of a return. As long as the ROE of the company is much higher than the investor's expectation, the stock price will keep growing. because that is what is a concept called economic value addition. The performance of the company over and above the investor's expectation. Right? When we are doing the modeling, we will even cover the valuation based on the economic value add also, that's again one more mode of valuation, where the focus is more on how much see, it's like this here. I mean, simpler way to interpret this. See, you are given some target in your company. That is what you are expected to perform. You perform over and above that expectation, your salary is going to go up. Correct? Which means you have exceeded your expectation. Exceeded the expectation, your market price is going to go up. Your value is going to go up. If you have underperformed the expectation, your value is going to go down. That's a regular normal logic. The same thing holds with the stock. The expectation of the investor is at least the company should generate 15% return on every rupee. Whatever is that number. You may have 15, I may have 10, you may have 25. Each investor is different based on the risk return characteristics of the investor. Each investor is different. So, if you are the investor who is looking at 15, if the company has generated more than 15, and every year it is generating like that itself, so that entire extra value addition of the company every year is adding up into the stock price. That is where an 18 rupees one is available at 502. So every year, if it can generate that kind of, in future also if it can generate that kind of exceeding of expectations, people are assuming that in future also the expectations would be exceeded in that way. So because of that, they are thinking that extra value addition that generated is something more, something more, something more. That is where they are ready to pay that premium. So that's a different mode of valuation called EVA based valuation. This is what is called as EVA. Any extra return, probably you can very well call, if the investor's expectation is 15%, that remaining 51.63% is the economic value add which the company has generated. Right? So this extra value addition that it is generating every year is what is adding up. Like as I gave you an example, if you keep performing above the expectations every year, your salary hike is also going much faster. The same logic applies to the stock price. There is an expectation set by the investor when he is, see, when you invest in any company, you have some expectation in mind. If I am putting my money in the bank, I am getting 7-8%. So I should get at least 15% when I buy the shares of HUL. That is your expectation. Now, as long as the company's ROE is more than that 15%, the demand for that company is going up. Demand for it going up means stock price is going up. There is a way we can arrive at that number also. Is 502 an appropriate price or not? That is what the valuation models will talk of. Right? Not in buying. For every 1 rupee that is there in the company as the investor's money, like the guy who has invested in the IPO of the company, he is getting, for every 1 rupee, he is getting 66 paisa profit. So people want to grab that opportunity. Because people want 15% sufficient. If you have bought the share in the IPO, you are getting 66%. Right? So at least someone is ready to buy it in the secondary market, thinking that, okay, even today if I buy it at 500, because the future is much brighter for this company, it will go to 600. Then probably I may get that 20% at least. So it's more like that. Right? So someone who has invested in the IPO is getting extraordinary. But now we cannot do anything with the IPO. We are more looking at buying it in the secondary market. At least if the numbers are very high, okay, this is giving more than 15% return. So obviously whatever the price I am paying today, there is a possibility that it can go beyond that. So when I do a valuation, what I will do is, okay, what is the real worth? Looking at all these excesses, and probably the future excesses, right? See, even from your perspective, okay, you say every year I have got 20% hike. When you go to a new job, you will say, oh, every year my salary is getting hiked by 20%. I'm saying exceeding expectations case. Every year your salary is getting hiked by, let's say, 20%. That's what you projected to your new employer. He knows that the typical industry average is around 10%. Right? So, oh, your salary is getting hiked by 20% means you are exceeding the expectation every year. So probably he may think you will if he thinks that you can exceed the expectations even in the next few years, he is ready to pay a premium to take you on the rolls. Much higher premium. Probably even if you ask for a 50% hike now, he may be willing to pay because he thinks that your performance will exceed the expectations even in the next 2-3 years. So looking at that, today he is ready to pay a high price to you. Right? So that way it can be operated out. So, I mean, as a simple yardstick, without getting into valuations and all that numbers, if I have to take a decision based on this ROE, the higher the ROE is, the better is the prospect of the company, the better is the profitability of the company on the investor's investment. So it is worth to pick up the share of the company. Right? That too, if it is big difference, 60 odd percent. But of course, one thing to be cautious is it is falling. Right? Though it is much higher, it is still falling. But we have to see with the industry also. Is the industry also more like this only? Is every competitor like this only? If every competitor is like this, then it is ordinary, like anyone else. Right? Because this number may differ from industry to industry. Right? Probably see, Infosys is having somewhere around 40%. Right? Or probably if you look at automobile industry, you won't see even 15% here. ROE will not be more than 15 to 20% in any automobile company. So it all depends on, so I have to compare only within the industry. I cannot say the ROE of this versus this because the kind of risk factors and the kind of costs, see, probably in automobile industry, the cost of goods sold is very, very high. Almost 72 to 75% is going as the cost of raw materials itself. Gross profit margins are very, very less. So final net profit margin is not even 10% or even 5 to 8%. Whereas here it is slightly better. So everything has to be looked at from the industry to industry. And in that industry, the more the volumes you sell, the more is the profit you can make. But per unit, the volume, the profit may not be significant there. There is a cutthroat competition. Whereas here it is slightly better off. Right? Even the final profit is still the same, but the return on investment, return on equity is much, much higher. So this is a very determining factor. Industry wise, if for all companies it is like this, probably this is a much better industry to look at from an investor standpoint. But if it is only this company which is having more like this, then this company is a better company rather than the industry. Right? Then the same logic people will do with respect to return on assets. For every 1 rupee of asset I have invested in, what is the profit the company is generating? For every 1 rupee of, see, total assets is like total liabilities. Balance sheet math. So for every one, total liabilities is nothing but the total capital that the company has raised. So for every 1 rupee of investment in the company, or for every 1 rupee of the asset of the company, what is the kind of profit the company has generated? See, in all these numbers, because profit is there in the numerator, the higher the number is, the better it is compared to the competitors. PAT divided by the total assets or total liabilities, the total. Almost 29%. For every 1 rupee invested in asset, the company has generated 23 paisa profit. So the asset is giving 23 paisa return. Right? So again the same. So I mean this will tell whether the company has invested very highly in assets which are not producing profits, or invested in assets which will produce more profits. Right? So the higher the ratio is, your all assets, including human assets, all kinds of assets, are working together to produce a higher profit. Right? So the ratio should be much higher to say that, okay, all my resources, the better way to put it is, all your resources together are producing close to 23.43% profit. So resource utilization is much higher. Again, I can't say higher or lower unless I compare with the past, because with respect to these 2 years it is much high, right? But after that it has slightly fallen. But again, it at least with respect to last year it has pulled up. Now I have to see with respect to the industry and the competitors. So the higher the ratio is, the better it is. Now this is where return on invested capital is both debt as well as equity. The long term liability as well as the shareholders capital. So probably I'll write it better as EBIT divided by shareholders funds. Actually, shareholders funds is also called as net worth. Net worth plus the long term liabilities, non current liabilities. So I'll get this as EBIT. So EBIT I'll get only from EBITDA. I'll subtract the depreciation, because here we don't have EBIT directly. EBITDA minus depreciation, this is EBIT, divided by the shareholders funds plus the non-current liabilities. So almost 83% to 61%, because the debt is almost not there. The ROE and ROIC, this is written, or typically call it as ROI, return on investment. The investment is both in the form of debt as well as equity. Because the debt is almost not existing, your ROI and ROE will be more or less the same. Because there are some long term liabilities, that difference still exists. Otherwise, it's almost the same. So for every 1 rupee invested in the company in any form, 61 paisa is generated as a profit. So the higher the number is, the more profitable it is to invest in that kind of a share. So profitability ratio on one side will talk about how is the company from the profit standpoint. Is it able to generate good profit? Is it meeting the investor's expectation? Is it exceeding the investor's expectation? If that is the case, if it is meeting, then it's a good point to buy that share. If it is not, then probably it's worth selling off the shares. So first determining what would be the investor's expectation. 15% is a reasonable expectation, right? If 15% is the expectation, if this ROE is crossing consistently that 15% by very heavy margin, that is what is contributing to the very heavy increase in the share price. We have to appreciate that part. If you try to compare for some other company, this number may not be that high, right? Probably just let's see, because we have a Dabur also with us, right? ROE, which is their PAT divided by the total shareholders equity. So what is the PAT for Dabur? 46,324, right? 46,324 divided by shareholders equity here, probably small addition, 17,421 plus 112,906, around 35% only. Okay, even these guys have crossed the expectations, but the numbers are not that great compared to HUL, right? In a case of HUL it is 66%, whereas in Dabur's case it is 35 watt. So that excess is not that heavy. So depending on what the excesses are, that premium will be higher compared to the current book value. Because the excesses are not that great, the premium corresponding to the book value is not that great. So depending on the performance, the premium will grow. And the valuation will help me in saying, okay, looking at all these premiums, what could be that extra premium? So is that premium already reached, or is it still to be reached? If it is still to be reached, I'll buy. If it has already reached, I will sell. That can be coming through our valuation models, right? The difference between the two is tax and interest. For every 1 rupee which has been invested by, sorry, for every 1 rupee of sale the company has done, 13.9 paisa is being given to the three investors. Government tax. I mean, it's not investor. Without investing, it is taking the money. So that 13.9 belongs to these three parties. So now when you say instead of 13.9, it is 16.9. 16.9 belongs to three parties. Probably you are getting more as an investor in the company. If you are saying 16.9 or 20.9, as an investor in the company, you are getting more. So you would be more interested in investing in the company. The more and more any profitability ratio, the higher and higher it is, the better it is for the investor. You would be showing more interest. Out of all these, ROE remains to be the key rate. As far as stock market purchase is concerned, ROE remains as a key ratio in this entire process. Right?